Hi everyone, I'm going to walk you through problem 3-59, which I've assigned to you. I like this problem because it walks you through the process of doing a reconciliation of book income to taxable income on Schedule M1 of Form 1120, which you guys will need to do when you fill out your 1120 for me later in the semester. In another couple weeks you'll be doing that. And it also walks you through how to do a tax provision reconciliation, which essentially is the same thing, but you slice and dice the reconciliation a little bit differently, but you still start with book income and end with taxable income. And when you go into public accounting, whether you're on the audit side or the tax side, you're going to see tax provisions likely, and you're going to be involved with either preparing or reviewing a tax provision someday. And so this is a really practical exercise. So first of all, we start with the first requirement is to prepare a reconciliation of taxable income to of book income to taxable income using Schedule M1. And to do that, here's what a Schedule M1 looks like on the tax return on Form 1120. It tells us to enter net income or loss per book. So our net income per the data table is $738,000. Then we enter our federal income tax expense per books of $231,540. And we, oh, sorry, this is, this is wrong. I actually want to enter my net income per books after federal taxes of $506,460, because then what this schedule is going to have me do, I don't know why that doesn't let you. You actually have to back it out to change stuff. Because then what it's going to have me do is add back it has you start with net income per books after federal income taxes up here on line 1, and then it has you add back the federal income taxes, because if you look on pages 39 and 40 of your book, there's a really nice set of book tax differences listed. Book tax differences are differences that are items that are different for book income than they are for taxable income. So you might have some items of income that are income for book purposes but not for tax, or vice versa. You also might have expenses that are expenses for book but not tax, or vice versa. And this is a really nice schedule that you want to use when you're doing things like this. So it does tell us in that table that federal income taxes are never deductible for federal tax purposes. So that takes care of the first two items. Then we have tax-exempt interest income. It's called that for a reason. Tax-exempt interest income is not taxable for tax purposes, although it is includable in income for book purposes. So that $10,000 is actually already included in this $738,000 for book purposes, but since it's not taxable for tax purposes, we have to subtract it out here, and you would list it right here. You list all these amounts as a positive number, because you'll see later that what it's having us do is take this book income and subtract all of the stuff over here that is income recorded on books not included on this tax return. Okay, so it's income for books but not for tax. Okay, then our interest on loan to purchase tax-exempt bonds. What is that? That's interest expense that's on the books that was expensed on a loan that was used to purchase the tax-exempt bonds. Well, there's a rule in the code that says To the extent that you have tax-exempt income, any expenses associated with that tax-exempt income are non-deductible. So that $7,000 is non-deductible because it's associated with the $10,000 tax-exempt income. So where we put that is, let me close this for a sec. Expenses recorded on books not deducted on this return, and there's not a line item for it here, so we actually put it in one of the blanks, and we find it here, and it's tax exempt interest, and it was $7,000 if you remember. Okay, so we've taken care of that. I wish this thing wasn't so big. And then we have maker's depreciation. Maker's depreciation is tax depreciation exceeding book depreciation. So there's excess tax depreciation over book depreciation to the tune of $40,000. So that means that you would put it on this line where it's listed, where you have items that are deductions on this return not charged against book income. Since you have excess tax over book depreciation, you would put it here. If you had excess book depreciation over tax depreciation, you'd put it over here. Expenses recorded on books not deducted on this return. Okay, does that make sense? So we put the $40,000 here. And then we have net capital loss. Remember my last really long lecture where I gave you guys a lecture on 1231 income and losses, and I also talked about capital gains and capital losses, and I told you that for corporations, net capital losses are non-deductible. You have to carry them back or carry them forward to a year where you have net capital gains. So this net capital loss is going to be non-deductible. It's $8,000. We have to find a place to put it. And right here, excess of capital losses over capital gains, $8,000. And remember, this capital loss is included in the book income. All of this stuff, the $10,000, the $8,000, that's already included in book income. But we don't get to include it for tax purposes. So we have to list it here as something that we're either going to add or subtract depending on whether it's a plus or minus. The next item is insurance premium on life of corporate officer where Omega is the beneficiary. Well, if you go back to that page where a couple of pages where it lists book tax differences, one of them is if you have a life insurance policy on a corporate officer and the corporation is the beneficiary on that policy, meaning if the officer dies, then the corporation gets the policy proceeds. To that extent, the life insurance policy proceeds when the officer dies, that's not income for tax purposes. Okay, what do we know about that rule? Wherever you have tax-exempt income, any expenses associated with that tax-exempt income are non-deductible. So the insurance premium, which is an expense for book purposes, that's non-deductible because we know someday when the officer dies and Omega gets the policy proceeds, that income is not going to be taxable. So that $9,000 we actually have to add back. And that gets added back here on the same side as the $7,000 interest expense that was paid on the loan to purchase the tax-exempt bonds. We're also going to put this insurance premium here, and it was $9,000, I think. Yeah. And then we have excess charitable contributions carried over to next year. So that means that that's $4,000 are charitable contributions that are non-deductible in the current year that we need to carry over to a next year. That's what that means. And you know the rules for charitable contributions. There's going to be instances where they're non-deductible in the current year because they might exceed 10% of the taxable income, right? So you put it over here. Expenses recorded on books, not deducted on this return. And that's where you put the excess non-deductible charitable contributions is over here. We're almost done. Our last item is the U.S. production activities deduction. That's the Section 199 deduction, the domestic production deduction that we get. And that's discussed in the book, and that's a permanent tax expense that we get. It's a permanent difference, meaning it's an expense for tax purposes that the books will never deduct. So that's called a perm difference, a permanent difference, and that's $63,000. So that goes over on the right side up here, down here, deductions on this return not charged against book income. That's where we put the U.S. production, and I think, what was it again? $63,000. Okay, so we've got all those amounts listed here, and at this point, I think I'm going to show the completed problem. Okay, so now I'm showing you the completed problem because I don't want to have to add it up while I'm doing this, because I'd have to get out the calculator. But basically what you do is you start with the 506, you add the 231, you add the 8,000, and it tells you right here to add them. You know, it tells you add lines 1 through 5, right? So you basically would add the 506, the 231, the 8,000, the 4,000, the 7,000, and the 9,000. You actually add those together and put a subtotal of 20,000, and then you add those to those two figures above. So you get a total on the left side of 766,000, and then on the right side we have that tax-exempt interest income, which is non-taxable, and we also have the 40,000 of excess depreciation for tax that we get to deduct, which is another minus. And then we have another minus for tax purposes, which is 63,000. All the stuff on the left are pluses, they're add backs to taxable income. All the stuff on the right are deductions from taxable income. They're reductions to taxable income over what you took on the books. So those all add up to 113,000, and then we basically subtract 6 from 9 to get 653,000. That's our taxable income, 653,000, versus our book income after tax of 506. So we actually have more taxable income than we do for books. Then down below, requirement B is to prepare a tax provision reconciliation. They walk you through how to do this in the book, but here's what it looks like on a piece of paper. You start with your book income, but this time you start with book income before federal taxes. So that's where there's a little difference between Schedule M1 and a tax provision. For tax provision purposes, you always start with PBT, profit before tax. Whereas for tax purposes, tax return purposes, you start with profit after tax, and then they want you to add back the tax, okay? You're still going to end up with the same thing. Then when you're doing a tax provision, you start with all your permanent book tax differences, and you add and subtract those to come up with your net income after permanent differences. Okay, there's 4 permanent differences that we are dealing with. The $7,000, the non-deductible interest on the loan, that is a perm difference. It is never going to be deductible for book purposes. For tax purposes, but it is deductible for book purposes. The $9,000 insurance premium, never going to be deductible for tax purposes, so it's permanently non-deductible. The $10,000 is permanently non-taxable, which is why it's a minus here. The $63,000 is permanently deductible for tax, not book, so it's a minus also. So now you have net income, you just add those, you just sum from 738 all the way down through the 63, and you get 681, which is your net income after perm differences. And then you have 3 temporary differences. We're dealing with all of the book tax differences dealt up here on Schedule M1, but in a different way, in a different type of schedule. Your temp differences are your capital loss. Why is it a temporary difference? Because you're going to carry over that capital loss to some other year and you'll get to use it in some other year. Oh, right? So that's temporarily non-deductible this year, but it will be deductible in some future year, we hope. And that's why it's called a temp difference. The excess charitable contributions, they're not deductible this year, but we know from what we read in the text that they're carried over to a future year where they can be used when your taxable income gets to be greater, and therefore when you multiply taxable income times 10% and you don't have very many charitable contributions in a following year, in a subsequent year, you'll be able to use this 4K. So it's a temporary difference. Same with depreciation. Your depreciation is going to change over the year, over the life of your fixed asset for book purposes and tax purposes. Over the life of that fixed asset, there will be some years in which your book depreciation will be higher than tax, and there will be other years in which your tax depreciation on that same asset will be higher for tax than book. And that's because for tax purposes, we normally use accelerated depreciation. It's called MAKERS depreciation, which is double declining balance. And for book purposes, we always depreciate assets straight line. So in the first half, around the first half of a fixed asset's life, the tax depreciation will be higher for tax than book. And in the last half of the life, approximately, that's not exactly half, but approximately the last half of the fixed asset's life, depreciable life, it will actually be higher for book than tax. Okay, and that's just the way MAKERS depreciation works. And so you come up with taxable income of 653. You also have 63 here. Hope this helps you guys. Talk to you soon. Bye.